time to time. I'm Grant Conway, one of the portfolio managers here at Genus. I'll quickly introduce some of the other PMs in the room. There's Mary Lou over here. Sue is not here just yet. There's Margaret Lanthier, Ian Lusher, and Leslie Cliff here. So as many of you know, we're always open to suggestions on the topic for these panel of expert seminars. So please feel free to reach out to Genus Contact if you've got any requests or suggestions on these. But for today, we are lucky enough to have Kay Gray presenting to us on the seemingly ever-changing tax landscape relating to private corporations, trusts, and individuals. So just a little bit about Kay. She is a tax partner at Grant Thornton, has over 20 years of experience in Canadian tax, helping many high net worth families, trusts, and private corporations. And in her tenure there, she's led many of their teams, both in BC and nationally for Grant Thornton. So without further ado, over to Kay. There we go.
Thanks, Grant. I see lots of friendly faces out there. Welcome, everyone. I just saw the weather forecast for Friday, so it's a good day that you came today. Apparently, we've got snow on the way. So while you're stuck inside, you can review your little booklets that you've got. Not sure of everybody's situation in the room, so I put together some information that's quite general in nature with the hope that you'll want to ask me questions that are more, so you can get some better understanding. So please make a note in your book if you have a question, and at the end, I'm happy to answer any of the questions you might have. I always say, if you've got a question, everybody's got the same question. So, what's old is new again. There has been a lot of tax changes in the last 2 years. I thought I'd start by just running through a list of what's changed. January 1, 2016, just over 2 years ago, we had major changes to the taxation of trusts and estates. I don't know if this was as well known in the community as it was within our tax professional circle, but it was a major shift of the way that we handle wills, estates, trusts, and even family law was affected by it in many ways. It affected the charitable giving. As you know, when someone dies, they're deemed to have disposed of all of their assets. If you've got a surviving spouse and the assets are going to that spouse, well then they go at the cost and the tax is deferred. But to the extent that they don't go to a spouse, they're deemed to dispose at fair market value, and so death is often when we have our largest tax bill. And many people have in their wills to make a charitable donation to offset the tax. And all of that changed. You don't get your charitable donation in your date of death return automatically anymore. So that affects almost everybody in this room who has ever done a will that has philanthropic intentions in it. And we'll come back to that. Also, in 2016, the government cracked down on the principal residence exemption. It said too many people were taking advantage of it. Our real estate market was so strong and buoyant, and people, myself included, sold their principal residence in 2016. Yes, it was, 2015, and at a very nice profit. And but we had lived in our house for 15 years. It was our residence. Apparently, there's many people who are flipping homes or doing things that are taking advantage of a strong real estate market without actually fitting into the criteria of a principal residence. We'll talk about those changes. Another change in 2016 that is probably not that widely known at all outside of the tax community is the rules around intercorporate dividends. Under Canadian tax law, it's based on a concept of integration, which I'll talk a little bit more about. But it basically says that when one company pays a dividend to another company, that dividend doesn't have to pay any more tax. Because somewhere down at the bottom of the chain, the company paying the dividend paid the corporate taxes, and it won't get taxed again until it pops out at the top into a person's hand. Well, that's been great, but now they've narrowed the rules down so that any company paying dividends, especially a private company paying dividends to another private company, really needs to think twice and make sure that they're fitting into the exempt rules so that they don't have to pay taxes. Then in 2017, they decided too many Canadian companies were claiming the small business deduction, so they narrowed the rules there. The small business deduction allows a company, a private company in Canada with active business, such as making things, selling things, having employees and things like that. It allows it to claim a reduced rate of tax on its first $500,000 of taxable income. And that tax rate is very low, with the idea that with them paying less tax, they'll take the profits and plow it back into the business, increasing their capital investment, hiring more employees. So in 2017, they decided that too many businesses were paying low rates of tax and not doing that, so they narrowed down and even eliminated the small business deduction for certain companies, and I'll come back to that. Then along comes 2018. You might remember there was quite a lot of press last July when our Minister of Finance, Federal Minister of Finance, released some proposals to change the taxation of family income, and particularly where that family income is derived from a private corporation. We call it TOSI, or short for tax on split income. And that's effective now, and so we're going to talk more about that. Starting next year, or to be more specific, starting for taxation years commencing after this year. And I say that because unlike a person like myself, a corporation can have a tax year that is not a calendar year. And so if I have a corporation that has a March 31st year end, these new rules that I'm going to talk about in a minute, they come into effect on April 1st of 2019 for that corporation. And those are the rules that you've probably heard about that came out in draft legislation form in our federal budget that was announced at the end of February 27th. And it deals with private companies that have passive income. And I'll, again, talk about that and how it could affect you. And then another one that I won't talk about anymore because it just was announced in the budget, but the federal government realized they just didn't have enough money to implement it, at least not for a while. So it was delayed for another 3 years, was the proposals to increase the reporting requirements for many trusts. And I can only assume that what they're trying to do is to make sure that when income flows through a trust and out to a beneficiary, that they're able to track it to make sure that beneficiary does actually report that income, particularly for offshore trusts and offshore beneficiaries. So that is what's happened in the last 2 years. A lot of changes. And so the landscape is completely different from a legislative perspective. But like I said, what is new was sometimes old, because look at where we are. So what I've got at the top here is, as an individual, if you have over $205,842 of taxable income, every dollar over and above that will be taxed at the highest rate. And so that means that if you had $205,843, you'd have $1 that was taxed at any of these rates, depending upon what it is. And so we're getting pretty close to the 50% threshold. And that means that we're getting close to where we were 20 years ago again. I don't know if you remember. I sure do. But it was around between 96 and 98, we were actually paying 54%. And then we started getting a balanced budget in Canada, and our federal finance ministers decided to start dropping our personal tax rates. And they went down, 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 and we even got as low as this used to be our highest marginal rate on ordinary income was 43.73%, was about 4 or 5 years ago. And now things are starting to swing back up again. So this year, we're up 50%. It's if you have dividends, non-eligible ones, like normally ones that come out of private companies, you're going to pay 43.73%. Eligible dividends, the kind you get from public companies, and capital gains. We used to say capital gains were taxed around 20%, no longer, 25%. We use that. Corporate taxes are kind of going the other way. They're depends on what you look at. If you look at a corporation that earns active income, in other words, income that takes effort to produce that, revenues, selling things, making things, that tax rate is still pretty low. Your first $500,000 is going to get taxed at just 12%. And over the next few years, it's going to march downwards even more, 0.5% per year for at least another 2 years. Once you're over the $500,000 of profit, every dollar after that is going to attract tax of 27%. So if you think about a business that is earning $1 million of profit, it's going to have 12% tax on the first 500, 27% tax on the next 500. If that owner of that business was to pay a salary to themselves that was over the $205,000, they would pay 50% tax on that salary over top of the $205,000 amount. So there's a very big incentive to leave your money in the company if you don't need it to live on. And this is part of the problem, why some of these new rules have come in, because a lot of private business owners have left their money in the company. They've left it in there so they don't have to pay those high personal taxes, and they've reinvested it in assets which don't necessarily produce active income. So if you're an owner of a trucking company and you used your profits to go out and buy more trucks and hire more drivers to drive those trucks, you're okay. Those are going to produce active income. But if you put the money into a GIC or buy a piece of rental property instead, then that's going to produce investment income. And now you're into a whole different tax bracket. So if we don't include Canadian source dividends, if you have a company with foreign income or with rental income or with interest, this is what the company is going to pay tax at that rate, slightly more than if you had earned it directly yourself. But also, because companies, part of this tax that's in here, you'll notice there's a correlation here. There's about a 20-point difference. That's because some of this tax here is refundable to the company if it pays a dividend to the shareholder. So the theory is that the company pays a lot of tax, but the government says, we'll give you some of that tax back, provided you push that income out as a dividend to the shareholder. The shareholder pays tax on it, and then you get some money back. So this is the refundable part of the tax. So the company would end up paying net, say, 20%, and then getting that much tax back. And then if it receives a dividend from a Canadian company, it's going to pay a temporary tax. We call it Part 4 tax, kind of like a holding tax, so that it discourages private companies from holding on to dividends. We're going to make you pay a 38% tax because if you remember, if they paid it out, the shareholder receiving it is not going to pay more than 34% tax on it. So there's a disincentive to retaining your public company dividends because you're going to pay 38.3% tax just to hold them in your company. It's like making an interest-free loan to the government.
Does investment income include capital gains?
Yes, the taxable portion, which is still 50% of the total capital gain. Yeah.
So 25%.
So if you had $1 of capital gain, half of it is taxable. And so on the dollar, we use a 25% rate because that already takes into account the 1/2. That's right. We all thought that the government was going to change that inclusion rate from 50% to 75%. We've seen that before, and they didn't. And you know, it's funny because one simple change like that would have actually meant a lot of these new rules weren't that necessary anymore, but they didn't. So, and when you look at 20 years ago, look at the small business deduction. It's 5.5% down. I mean, the tax rate for active business is down, and this rate here is down as well, 12%. So for active income, corporate tax rates are heading down, and investment tax rates are heading up. I mentioned integration. So the theory is that if I go out, oops, there's my mic, sorry. You told me not to do that. If I go out and put $100 into a portfolio that's going to earn me some investment income, and I did it personally, so it's in my name, Kay Gray. I earn that income and pay my personal tax on it. If I instead put that money, $100 into a corporation, and the corporation earns the investment income and then pays the profit to me as a dividend, the theory is that we should end up being the same amount of tax. So that's called integration. Where are we today with these new rates? Well, if my dollar was earned directly and I paid the highest marginal rate, I would pay 49.8%. But if I did it through a company, yeah, did I knock it? Oh, you're right. Thank you. Better? Thanks. Do I have any like spinach on me or anything? I'm sure. You're a good guy to have around. There, okay. So it's almost perfect with active income. If you earned it through a company, after tax coming out, you're only going to have just over 0.5% more tax. Now, if you're making $1 million, that might add up to a lot, but it's relatively good. But if you're earning an investment income through a company, it falls apart. We have actually a 5% penalty that we're paying. If you earned your income in the investment company and paid it out right away to the shareholder, you end up paying 5% more tax. And in this case, remember, I'm making sure that we have a BC resident shareholder and corporation. So all these taxes are being paid in BC. Because if you were in Ontario, you're already paying a lot more tax. Ontario residents are, in some cases, 5% higher already than BC. And if you head over into the Atlantic provinces, you go even higher than that. So it might seem a bit of a stretch to say that we're a bargain in BC, but relative to the rest of the provinces, we're doing okay. So I'm going to start talking about some of the changes, and I'm not going to talk about them in the same order that I listed them in. That was a chronological order, and I'm going to start doing them now from more what's coming at you now. Now, you notice I've got the words passive in quotes because it seems like it doesn't really necessary. When you earn investment income, you basically sit at home and your money works for you. Leslie makes it work for you and gets that return. That's what they mean by passive. We don't have to expend any energy to actually make it grow in value. But there are some cases where you have investment income, but it's not passive, and that could be if you run a company that has like a lot of rental properties and you have more than 5 full-time employees in your company, then that passive investment income, being the rents you earn, it could be commercial rents, residential rents, but if you have more than 5 full-time employees, then that passive income becomes active income because now you've got engaged people in your business to help you run that business. So the magic is more than 5, not 5.5, but 6 or more. So when you're dealing with passive investment income, the change that is effective for taxation years commencing after 2018 is that private companies who pay that low rate tax, being the small business deduction, the 12% rate that I told you about, on their active income, is then reinvested in an asset that doesn't produce more active income, like the new truck. It is invested instead in a portfolio. They think that's unfair because you've only paid 12% tax on that, leaving more capital to invest. So that business owner is in a different position than the employee who has to pay tax on their salary and reinvest less afterwards. They thought that's not fair. So they said, okay, what are we going to do? Well, we're going to start restricting the eligibility of that company for the small business deduction. And they've created this arbitrary band. I called it arbitrary because they said they think it's reasonable for a business owner to save $1 million in their company for a rainy day fund. And the $1 million, if it had a 5% return, would earn $50,000. So that was their starting point of $50,000. But they didn't cut it right off at $50,000. They said, well, I'll let you, if you happen to go over $50,000, we'll just start clawing back the small business deduction. And then, and I'm already getting my scarf, aren't I? Sorry. But once you reach $150,000, your small business deduction is gone. And you're paying tax at that 27% rate, which is the next level of corporate tax. So this is actually hitting some of my clients in an interesting way. Where you've got a private company with one shareholder, no problem. That shareholder gets all the benefit. But I've got clients which have business partners. So for example, an active business, quite a big one, with 4 shareholders who are all arm's length with each other. But one of the shareholders owns half the company. And she has trying to retire. She's in her late 60s. She plans on selling her half of the company to the other shareholders in a couple of years. So she's been saving in her holding company to retire. And her savings are going to knock the small business deduction out of that active business. And so her 3 partners who own the other half of the company are now paying over $40,000 more tax, less cash for them. They're not very happy about it. So we've got to think about what can we do about that, right? So one of the logical solutions might be pay out all of her investment portfolio into her hands personally. Well, it's not that easy. We've got some commercial properties in there. We've got property transfer taxes that might have to be paid. There's a lot of tax that would have to be paid. So it's probably not an easy answer, whatever we do. We'll have to come up with a different strategy for income sharing. So where we think this one change might just have a problem over here, you'll find out that it actually reverberates through a lot of businesses. Another change that happened around passive income in private corporations is that, remember I talked about those refundable taxes? There was a refundable Part 1 tax that was 30.67% of your income. And there was a refundable Part 4 tax that was 38% of your income in the company. And they're refundable because where the company pays out a dividend, the company gets that tax back. They said, we're giving too much money back to the companies. We got to slow that down because we want to hold on to this money. I don't know if they actually said this, but I'm thinking they might have said that. I can just see them in a room talking about that. Because if I look at the government balance sheet, there's a huge liability out there of refundable taxes. I'm sure there is. They're trying to figure out how to slow the refund of these taxes down so they can keep the money. So they're saying, okay, we don't think it's fair that a company pays low-rate tax on active income, and remember it ended up being just 20% when you take the 50.67 and you subtract that, and then paying out an eligible dividend where the shareholder pays a low rate of personal tax. So we're going to create a lot of complexity, and we're going to make sure that when you pay out dividends, you have to pay those high-rate dividends out if you're going to get a high-rate tax refund back. So there is a lot of complexity coming. It doesn't start until taxation years after this, but we're doing a lot of planning right now to basically recover all the refundable taxes that are sitting out there that we can. That might mean paying some high dividends this year. It might mean some of our shareholders paying higher personal taxes to get those dividends out. But we think that it might overall be the better solution. But everybody will be in a different situation, and it's worth thinking about. And luckily, we do have the time to think about that. So those last two are all in the proposal stage. They were announced in the budget. The legislation is in draft. Our Liberal government is a majority government. I don't believe that they'll have any trouble getting it through and making it law. And I think they're waiting for some feedback and consultation, but I doubt that anything will change. So I think we can pretty well assume that that will go through. The other one, though, that is through and is law is something called the tax on split income. So what was their concern? Their concern was that Canadian business owners are able to use their private companies to pay dividends either directly to other family members or salary directly to other family members or interest, and have that other family member in a lower tax bracket pay the lower tax. So they're thereby reducing the family's overall tax burden. I actually thought it was brilliant. I made my living on doing this thing, so this is a big impact for me. So basically what they're saying is that if you have a company and you pay a dividend to anyone, a family member under the age of 65, that dividend could be subject to the highest marginal tax rate across all of it. So no more low-rate tax dividends. If you have a child who's 35 and works in your business, and you pay them a little bit more than what they're worth, then you might have a problem getting that extra little bit more. That little bit more than what they're worth is called the split income portion, and that it might end up getting taxed at the higher rate. Most of my clients don't pay their child what they're worth. They actually pay them less, so I'm not concerned about that. But I do have lots of income splitting going on within family members. These rules were first announced in July of 2017, and there was a huge uproar. The government received over 21,000 submissions from across Canada, telling them, I guess, in words that probably were not that, civilized, that they were completely off their rocker. They listened. They listened because I think the backbenchers really got upset because they were getting inundated by their constituents coming and telling them that these were crazy rules. So the new ones that came out, they basically threw out the old ones and brought in new ones in December. And the December ones definitely are better, but they still are substantially the same in that we can't split income with family members. So that's in effect, starting right now. Doesn't mean you can't pay family members' income. It just means their tax is going to be higher. So it's not as effective. So maybe if you're already in the highest tax bracket and you pay a dividend to a spouse or a child, then they just have a higher tax. You're in no different position. It depends, though, what they're going to use that money for, because if they start investing it, then the investment income is tainted as well, and it will also continue to be split income. The principal residence exemption, this is already law as well. I talked a bit about people who flip homes. We also have changes with around the reporting. While it wasn't the law, CRA had an administrative position that said, if you only own one residence, one property, and you sell it, and it's your principal residence for every year that you've owned it, you don't have to report it on your tax return. Matter of fact, they discouraged you from doing it. They said it took up too much of their time. So they came back, and I guess they said, no, we got to get people reporting, because that was the first problem. They had a lot of these real estate transactions going on, no reporting at all in anyone's tax returns under this administrative position. So now we must report, and you must make a designation that you are sold your principal residence and that you've lived in it and satisfied all the criteria that it was your residence. And so that was another change. Another change was that people would sometimes hold their principal residence in a trust, in a family trust, for example. Maybe they had a reason for doing that. One reason might be is that maybe they have helped a child buy a home, and the child is having some matrimonial issues, so the trust is used as a protection mechanism for that house. But now those types of family trusts aren't allowed to have access to the principal residence exemption. Some trusts can still, those alter ego trusts, joint spousal trusts, they're okay. And if you have a disability, there's some disability trusts as well. But for the most part, these are now restricted to individuals that own their homes. Starting last year, they eliminated the small business deduction for many professional corporations that were part of a partnership. They call it specified corporate income now. So as an accountant, I'm incorporated. I'm incorporated for a reason, mostly to protect myself from liability, because I have 200 plus partners who I don't know what they're doing. And if they go out and make a mistake one day, I could get sued, and I'm part of that lawsuit. So I try and protect my personal assets by practicing through a corporation. But what these new rules say is that my corporation can no longer get the small business deduction. So that means my corporate tax rate, instead of being 12%, is now 27%. I can live with it, but it's a big change, and it's a big cash flow drain. The upside is that instead of getting non-eligible dividends out, I get eligible dividends because it's coming from income taxed at the higher corporate rate. I've also, we had a big change in 2016 on estates and trusts. It used to be that when an individual passed away, their assets flowed into their estate. They rarely fly, but they do flow very slowly. And that estate then had to be administered by the executor or the personal representative for the deceased. There are times when it takes longer than normal to administer. You've got to pull in the assets, you've got to value them, you've got to sometimes sell them. You have to find all their beneficiaries. Sometimes there's beneficiaries you don't know about. You've got to locate them, prove that they are beneficiaries. And to the extent that that estate was earning income all that time, it could be taxed as if it was still a person. In other words, marginal tax rates. So they said that's unfair because they thought maybe people were leaving those estates around intentionally longer than they needed to. So they said, okay, after 2015, an estate can only be a marginal rate, or called a graduated rate estate, or a GRE for short, for 36 months after the date of death. And after 36 months, every dollar of income it earns pays tax at the highest marginal rate. So that was fine. So we've got that change. But then they went and said also, and any testamentary trusts that you set up in your will, they're automatically going to be taxed at the highest marginal rate as well. So it was a common practice for my clients to structure their wills so that they always ensured that their grandchildren, for example, had an education fund. So that they would say, you know, I know my children are good parents, but I don't quite trust that they're not going to spend it all, so I'm going to set aside some money in my will for my grandchildren. So let's use a number. Let's say they set aside $50,000. And that, while it was in that testamentary trust for that grandchild, because maybe they're still too young, it would accumulate, and you could get marginal tax rates on it. Well, no longer, because testamentary trusts that are set up in a will now are taxed all at the highest rate. But on top of that, there's all kinds of those tax on split income. So if the income is coming from a private corporation, then that minor child is going to get taxed at the top marginal rate as well. So we've got all kinds of little potholes we could step into when we're doing estate planning now. And we really need to be careful. And what I think is coming out of this is if you're pulling your will out to have a review, think about it with respect to these new tax rules. One of the biggest changes was around charitable giving in a will. As I mentioned at the very beginning, it used to be that if my will said I want to make a donation to a registered charity, then that amount could be used to reduce the tax on my death. But now it doesn't actually happen that way. What happens is if it takes my executor 2 years to actually make the gift out of my will, then out of my estate, then my estate has to claim the gift and then apply for a carryback, which means you have to actually pay your tax and then get a refund of it. And if you don't pay the tax, you get interest. The current interest rate is 5%. So there's a cost to the way they've changed the rules. They're not sort of taking it away. They just want to get their money up front and then make you work to get it back. So where do we go from here? And I haven't talked about all the changes either. There's still others that probably don't affect some of you in here, so I didn't include them. But I think there's 4 points to take away. Think about your existing structure. If you have a private corporation, find out why you have it. Think about whether you really need it anymore. For many of my clients, I'm thinking about ways of starting to empty out their corporate structures. If you've got a trust, why are you using that trust? There's still very good reasons for using trusts. There might be a good reason to hold it, but then you just have to factor in the fact that you've thought about it, you understand why your trust is there, and think about the implications of keeping it. Rethink your income splitting. Make sure if you've got a family member working in the business that they're actually getting paid what their market value is. And if you're paying dividends to other family members, be prepared that they're going to have a higher tax bill. Warn them ahead of time. I mentioned earlier with these new refundable tax restrictions for passive income in corporations, consider clearing out your refundable tax that's already sitting in there. I have some clients that have hundreds of thousands or $1 million of refundable tax on their tax return that they just need to pay dividends to get that back. And lastly, and I think this is one of the most important, is to revisit your will. And if you're doing any charitable giving in the will, make sure it still works from a tax perspective anyway. Is that too soon? Too long? Okay. I don't even wear a watch. I just sort of.
No, that's perfect.
Okay. But I will take questions.
Yeah, and maybe if there are questions, we'll just repeat them for the sound of the audio recording.
This current government doesn't seem to value the contribution that small businesses make to our economy. We started a business 11 years ago. We started with 3 people. We're close to 20 people. Why did not have to take a bank loan to start the business? I didn't have to collateralize my house too, but some people do. The current government doesn't seem to want to value what small business does for our economy. People in my family took risks. Those risks are not being valued at all. They want to pay me exactly like I'm getting a salary. If it's so easy, go out and start a business yourself. Start, own, and run a business. And see how easy it is.
This is very true. There was no respect given to the risk that a small business owner.
Nor the contributions of the family.
Of the family members, exactly. That's right. Yeah.
So, is the pendulum ever going to swing back?
We're the voters.
Yeah.
You voted them in.
I did not. I never reveal my political standings. I did not vote.
Well, I think, Vince, that this has been an extraordinary year for changes, and I think that while the Liberal government has a lot of great ideas, there's also been some real eye-opening with ones that we've had a hard time with. And I do feel personally attacked as a professional. I've had a lot of tax changes that personally affect me. I think about some of my younger partners who have huge risk, who, you know, we don't get paid until after all the employees are paid, and it might not be very much left, but yet they're sort of being told that they are doing things unfair because it's not fair. So I think we need to, probably we won't change everything, but I do think we need to be a bit more vocal about the way our country has been very successful, to the point, at least this is my personal view, not Grant Thornton's view. I think we've got a great country, and we've had great balanced budgets, and I suppose we just need to be vocal about what our government spends their money on.
If you extend this out, this could stifle Canadian entrepreneurial spirit.
I do believe there is that. That could happen, or people will be encouraged. I mean, we look at the things that are happening right now with NAFTA anyway, and I'm no NAFTA expert, but there might be a disincentive to starting a business in Canada versus in the US. So capital might flow right away.
Blaine, Washington is not that far away.
So, you know, depending on how the NAFTA talks go and depending upon a whole bunch of other, I mean, US tax reform, I didn't even talk about it. It's clearly designed to keep money in the US, whereas our tax reform is more of a, you know, earn your profits outside of Canada. So we'll see, because for years we enjoyed being the attraction for capital. We had a low foreign exchange rate, so we had a lot of American and other foreign money flowing into Canada. I think it's going to slow down. Margaret.
I was just wondering if you could touch on a couple of strategies that people might consider as opposed to private corporation, IPPs or individual pension plans or anything else.
Mm-hmm.
What do you recommend that your clients do? This is great to hear how it can be impacted, but are there recommendations?
Well, I think you look at what type of business you have, because that, again, determines the need for using the corporate structure. Sometimes you cannot avoid using a corporate structure. You need that. The whole reason for corporations as well, not all the reason, but part of it is the protection. You have limited liability as a shareholder. So, there's lots of reasons to still have that. So I wouldn't recommend that we just toss corporations out right away. We need to think about that business. You need to think about the age and stage of your family members. If you're doing income splitting with them, maybe it's time to get them off the payroll. That's always a good thing, maybe, if it's possible. Ways of saving for your grandchildren or your children through RESPs, even helping them with our RSPs through gifts, right? So that you can achieve, by making a gift of money, they get a tax reduction through their RSP contributions. So maybe there's some things you can do there, depending upon your personal situation and what you're committed to with that child. Many parents continue to help children with university education. I think that is, there's got to be, you can't use a private company dividend for that anymore, but maybe it's time that they worked in the family business or got a job somewhere that you could help them get their own income. So it's a tough one. They've really kind of put up a lot of barriers around this. Does anybody have any ideas? I mean, this is really something that I'm sure a lot of people are thinking about. And
What about that individual pension plan?
Yeah, so an IPP is a solution for a business owner. It's not that different from an RRSP in that you can't have double. You either one or the other, or you split them, right? Yeah.
Can't you, to some extent anyhow, it has disadvantages, just give money to adult children?
Absolutely. As long as you're not American.
That is partly my point. This is one of the ways in which, for example, if one is forced to take more dividends out, that one can put the cash into perhaps a more effective use, particularly if they're not in a top tax bracket.
Yeah, so making a loan to your child is another way, as long as you charge interest on the loan. Yeah, that's right. So that's an interesting question. So should you gift or should you loan to your children? For income tax purposes, we have these rules called the attribution rules that say, if you make a loan to your child and they take that money and invest it in a business, no problem. There's no attribution of the income that's earned in that business. But if they turn around and put it in an investment portfolio or in a rental property earning that passive investment income, That income is now attributed back to the parent and must be included in the parent's income.
Is that true of an adult child?
No. Yes, it is. Yes, it is. Sorry, you're absolutely right. It is an adult child as well. Yeah. So to avoid that, the parent must put an interest payment on that loan, and using the prescribed rate, which is currently 1% per annum, probably going up soon, and they have to actually pay that interest every year.
And that can only be done though with an adult child.
Yes. And then the other option is to just write a check and make a gift to the child. And if you've got a gift that's gone with no expectation of money coming back, then the child can do whatever they want for that gift if it's an adult. And I'm only talking adult children here. And for BC, for Canadian tax purposes, adult is 19 and older, 18 and older. Obviously, I'm getting legal adult, I think for BC is 19 and older, but for tax purposes, an 18-year-old is an adult. Our new tax on split income rules have created this new age group of 18 to 24-year-olds, which have some special rules, to target those children who are going to university, I guess, thanks to their parents. So.
Life insurance came through unscathed.
I know.
Still in corporate.
Yeah.
So any opportunities there?
From the life insurance guy. I kind of expected that one. I'll get your question next.
You got a strong lobby.
You do. You don't need any help from me. Well, I'm the first person to say life insurance has a place and a purpose in everybody's investment portfolio. I think when I look at my client base and when I look at my partners and our employees, they're grossly underinsured if they had a problem, both from a disability perspective and from a life insurance. They'd leave spouses and young children behind. We're always saying we probably need to really think about how much money it would cost somebody to raise a family if one of the spouses lost their life prematurely. And then on the other side is insurance as an investment asset. It has a place and a purpose as well, depending upon your horizon. And, Vince, you're the guy to talk to about that. It is, while your income is earning in that insurance portfolio, it doesn't pay any tax. That's one of the beauties of the insurance business. For some reason, they've said it's a tax-free thing over here.
Has to do with Sir John A. Macdonald.
Something like that. I'm just going to go here. Is it?
I think you said.
Betty, that's it. It just had the light shining on your.
I was just thinking, I think is there an exemption for the TOSI rule where if you're 65?
Yes, yeah, that was one of the relieving measures that were introduced.
Does that apply, or is that valid if it's for professional corporation, professional type of business, or does that take you out of that? So does it depend on the income?
So
Or that 65?
maybe just repeat the question as well.
So I'm trying to think. The question is if I'm a shareholder in a professional corporation and I split income with my spouse and I'm 65 or older, am I exempt from the TOSI rules? I think so, but I don't want to say for sure yet.
So
Yeah.
it's not some of the rules for the TOSI,
Oh, I'm so sorry.
the exemption does not apply because it's a professional type of income. So I'm just wondering if that's 65.
Yeah, so these are the ones where they came out in December, and there's a lovely little flow chart I refer to, but I have to refer to it every time to give an answer. I'm just not that intimately familiar with all the little nuances of it yet. Mark.
Okay, intercompany dividends, you mentioned that the rules had changed.
Oh, yeah.
Is there a quick summary of what?
So a little bit, yes. Quick summary, because I'm actually speaking on this in 2 months. As I mentioned, when one company pays, we'll use private companies only because public companies sort of operate in a different realm, but private companies, when one private company pays a dividend to another private company, so the parent gets a dividend from it, so typically that would go as a tax-free dividend. And so if you're operating an active business, you don't like to keep a lot of excess cash in your company, so you would typically dividend that excess cash profits into the holding company where it could be reinvested. Typical normal course dividends out of profits that have been taxed in the bottom company are still safe. But if you're paying an extraordinary dividend of some kind, or if you're buying out a shareholder that's up there, then you've potentially got this problem. The problem is that part of the dividend will be deemed to be a capital gain and taxed to the recipient company as a capital gain. And the onus is on the recipient shareholder to prove that it was paid out of tax-paid income. That's it in a nutshell.
Did they make any changes to capital dividend account? I don't think they did yet.
No, I don't believe they did.
And so if you happen to have a CDA balance in a company, you could do the election form and pay that out to the non-active.
That's right. The dividends I was talking about, the intercourse, are only taxable dividends.
Right.
That's right, yeah.
Yeah, but if you have a CDA balance in your company, you can still distribute those out.
Absolutely, yeah. Yeah. Hope so. They don't take that one away yet.
They haven't done it yet.
Yeah.
They announced it in the initial papers.
They did, yeah.
So are there any further questions? I'm conscious of people's time and don't want to sort of overrun too much, but if I think that's it,
Does
then...
anyone want to challenge me on what I said?
Yeah.
Please?
Well, thank you all very much for coming, and thank you, Kay.
Thank you.